Great. Well, thank you very much. Welcome. We're here today to have a conversation around generating alpha in an era of instability. And I thought that it would be worth setting the scene in terms of the sort of central scenario that we all see. And I think maybe Richard, you can lead us on that in terms of your current thinking.
Yeah, I guess it's interesting to reflect on this instability point, because central banks are clearly trying to make a number of markets less unstable. And frankly, they were very successful during March in stabilizing markets from a liquidity perspective. And I guess what we see now is that they've continued to damp down volatility, certainly in a number of the fixed income spread asset areas. And in a sense, you could say there's two worlds. There's the world that you can live in where your volatility mark to market is somewhat constrained, but at the same time, your future returns also pretty constrained because spreads have been compressed. And then you've got a world, and they're not entirely independent, where there's less impact from central bank intervention directly. There's an indirect effect. Market prices are set by market practitioners to a greater extent, but there's a lot more risk. So I guess it's a kind of low risk world that's been stability induced. And then there's the world of emerging market currencies, emerging market debt, the higher spread areas of credit, where prices are more freely determined, but the risks are a lot higher. So I think that's a really interesting kind of dichotomy of markets that we can think about when we're thinking about alpha, because there's opportunities in both, and to switch between the two is important as well.
Yeah. And Chris, do you agree with that, or do you see other options?
No, I do agree with that, and I think a lot obviously depends on what happens at the macro level, and if we do continue to see this kind of stuttering recovery, but central banks being very supportive, then I think people will continue to be drawn to those high yielding, more risky assets, and I would include obviously equity markets in that. One thing that we've been discussing quite a bit is, do you still use the rates market as a hedge against risk turning sour? And given where yields are, and particularly, your 10-year government benchmark bonds are kind of just above policy rate levels, is there that opportunity still to have duration in the portfolio just in case your high yield or your EM debt positions turn sour? I think there is, and I think there's some steepness, particularly in the US curve, as a kind of defensive measure. But then that begs the question of what happens post the election with fiscal stimulus and so on. So I think there's a lot going on that could generate volatility in these markets.
And I think we obviously also want to talk a bit about diversity across portfolios. Is there a risk that with what seems to be almost a bifurcated bet on and all based around central bank support, that actually we're not really creating any diversification?
Well, I think I was going to say that we have to differentiate between what they've done between the factors of looking at liquidity and insolvency.
Yes.
And many of the very aggressive, timely actions of the central banks has been successful in making sure that liquidity is in place, financial stability and financial conditions have improved since the risk off in March. But they're not in the business of essentially buying out insolvent corporates or high yield companies. They've been very clear, particularly the Fed, in what fallen angels they're going to be buying. In a sense, when you look at it, it's only 8 tickers, the like of Ford. And as an investor, if you're looking at different parts of the spread market, it's quite important to have that differentiation, especially if you're going to the riskier part of high yield. In the sense that the central banks are not stopping the default cycle. So when you even look at the U.S., we're still seeing restructurings in the energy, retail, and leisure. So I think we view this environment as an up in quality environment in the sense that a lot of good news has been priced in already, particularly in high yield. We do have a preference in some of the investment grade corporates that are in we would call it the central bank umbrella. So I think that, when you're a global investor, particularly when, valuations are currently not as attractive as it's been since March and April, it's very important to be selective, but also have that diversification. So we're looking at cross-market trades, not only in spread markets, but also in different parts of the yield curve. And there are opportunities out there, but you have to be able to have sort of strict trading limits and such.
And do you have any views or strategies in place to protect the portfolios in the event that the music does stop and perhaps the central banks don't provide the levels of support that they have been providing?
Yeah, and I think that's one of the things. One is making sure that we have enough of cash liquidity investing in liquid spread securities, but also having beta hedges in place. So this is one of the reasons why we view that there is a number of cluster of volatile events in the next 30 to 60 days, if it's Brexit negotiations, US elections, as well as further news of COVID or vaccine news that could basically drive risk sentiment quite quickly. So we're having our betas across our different ag and your ag strategies quite close to neutral. We're kept a lot of sort of dry powder to essentially take advantage of any sort of risk off events. At the same time, we've used EM FX shorts as a beta hedge as well, in a bout of risk off sentiment. And the other as well is that we're looking at curve trades, sort of certain types of steepeners, in the sense that if we do see some steepening of the yield curve, we wouldn't necessarily we'd make some, but if it doesn't happen, we wouldn't necessarily lose much for our clients.
I don't know, Richard or Chris, do you have any concerns around the current levels of budget deficits attracting rating agency actions that might have unintended consequences on the likes of, for example, banks that are linked to sovereign ceiling ratings, etc.?
I mean, I don't have any near-term concerns about that. Obviously, debt levels are rising pretty rapidly in most countries, and at some point there may be a reckoning of that. But with central banks buying, with strong demand for fixed income still from institutional investors, even at these very low yields, I don't see the supply, the fiscal outlook being a big negative for the markets in the near term. I think as we get into next year and we'll see what the election brings and what kind of additional fiscal stimulus that brings, it may become more of a concern.
Well, somehow, I mean, the impression needs to be given. I was just reflecting on this because it was recently my 30th wedding anniversary, reflecting back to that time in 1990. In fact, the day before my wedding, we entered the exchange rate mechanism and interest rates were cut from 15 to 14%. And at the time, inflation was 11%. People didn't believe it could be conquered. And we're now in a different era where we don't think deflation can be conquered. And, under rational expectations, it's very hard. You need to create something that people really believe. And it has to be not just a fiscal deficit, but the perception that you're willing to clip the currency, so to speak, in order to create inflation that would be a game changer. And I think in the short term, there doesn't seem much risk of that. And there's an enormous demand for long duration assets for all the reasons we know. But at some point you step back from the problem and say, if we are to be successful in getting out of this current spiral, it's likely that part of the solution will be inflationary, and that will be a big shock. And you'll have a destruction of wealth, which is not necessarily caused by inflation, but certainly impeded by rising real interest rates, because we've had that following wind from 4.5% real interest rates all the way down to -2.5%. And at some point, we're going to start going backwards.
And do you think there's any danger that that you see sort of more monetization in the form of sort of helicopter money? It's not something that's spoken about a lot, but it's an alternative scenario to the one that you've laid out there.
Well, we're seeing the beginnings of it. I mean, I think that what constituted radical policy 5 years ago has become pretty normal. I mean, who would have thought the president of the European Central Bank would be talking about overshooting the inflation target? But I think, you know, conventional wisdom is moving quite slowly, and I think there's been a slow radicalization of policy. But I do think it's a big step until helicopter money is literally there. But we're close to the point where that central bank independence is being eroded, and it's a tipping point that will come.
Regina, do you have any views on that?
Yeah, and I mean, I think that, you know, when we see that, you know, the recovery, the EU recovery plan that was agreed upon this summer, I think that, you know, it was partly a game changer for Europe in the sense that, you know, part of the financing that we're going to see in many of the plan is that you have some of the weaker countries being able to finance part of their recovery in very, very low rates. And the issuance of EU bonds that we're going to see in the next several years, you know, the EU will essentially be the third largest issuer in the European bond market after France and Italy. And this is something that's going to change the dynamic of European fixed income. In the same sense, you know, this is, you know, a new issuer in the market that would be coming in at a discount. But in the same vein, you know, all these programs are technically temporary. You know, they're not permanent. And at some point in the longer term, the question of debt sustainability and how we're going to pay all this ballooning deficits will be in investors' minds. But this is a longer term question. Currently, as investors, you know, we're unfortunately in a world that tweet storms, and the next debate is driving risk assets. And I think that, yeah, it's important to have your short term cyclical view and obviously the structural view. But you know, for us, our main concern is how the next 3 months will shape up, because I think that, you know, considering the volatility that we've seen in the first quarter, you know, I think that there are going to be some interesting relative value opportunities that are going to come the next quarter or so.
Do you think, I mean, we talked very briefly about currency, or touched on it from an emerging market perspective, but do you think that when one's searching for alpha, that currency now is coming back to becoming a separate individual asset class from which you can derive alpha, or is it are you purely looking at it from a hedging perspective?
Well, we just look at it from a hedging perspective, but I think broadly it's always been there as a potential to generate alpha. The problem is sometimes that alpha is negative because it's very hard to call currency moves. And I think we're at an interesting point now with the dollar, you know, a few weeks ahead of the election, because there's a consensus that is kind of bearish on the dollar, but that could quite quickly switch around if we do get a Biden win and a Democratic sweep. So I wouldn't nail too much to a particular view on currencies at the moment, and there are smarter people that trade currencies than me. But it's there as a potential source. I think for fixed income investors, though, we have to be mostly concerned about yield and credit and the volatility of bonds, rather than, you know, that additional potential alpha you can get from trading currencies.
And Richard, I think you touched on emerging markets at the top of the call. Is that, are you holding a similar view there?
I think there's been enormous growth in the local currency bond markets, and I think that stretches back beyond the Asian financial crisis, but that kind of supercharged it, and it's been very welcome. And I think originally you've got domestic institutions investing in them, but now you've got more foreigners. But it's really an under-owned asset. I think there are many who are dollar denominated and feel comfortable with the old Brady bonds, illiquid as they might be. And their preferred habitat is dollar instruments. And I think that does leave an opportunity for investors, because the cross-sectional distribution of returns of local currencies and local currency bonds is huge. So if you're talking about alpha, the potential for alpha generation is enormous. I think you're not competing for risk premia in quite the same way that you are with the dollar issues, or even dollar credit for that matter. And so in my view, it's an interesting underappreciated asset. And if you want to go out on a limb a little bit further, look at inflation-linked emerging market debt in local currencies, because it's got some quite interesting natural hedging properties when you think about the relationship between currencies, unexpected inflation, and the local tips. So I think that, you know, the landscape's changing. China bonds are very interesting. And again, in a sense, it's a bit of a consensus trade alongside what Chris said about, you know, bearish on the dollar, but Chinese bonds are pretty interesting together with gold. So I think emerging markets are not, although the health pandemic has hit them badly, I think they do have the potential to earn that risk premium.
Yeah, I was going to add to that, for us in our macro strategies, we have used EM as a way to add alpha, but considering the volatility, our risk budget is relatively small compared to the other levers of alpha generation in our strategies. But I think that one of the things that we have seen this year is that you know, with the reaction function of many of the EM central banks, you know, they are behaving more like the developed market central banks, and in the sense that, you know, they have been prioritizing a lot of the domestic financial stability and keeping credit conditions loose, but having a bit more willingness to sacrifice some of the FX stability. So this is the reason why you've seen a good amount of volatility in EMFX, particularly some of the higher beta fragile currencies, such as, you know, the Brazilian reais, South African rand. So I think that, you know, this differentiation is very, very critical, particularly in EMFX, but also obviously in both local currency and hard currency markets.
No, great, thank you. And I guess maybe one subject to touch on is really the proliferation of the active versus passive debate. Does this scenario that we talk to here, does that change the structure of that debate? You know, is passive more in favor, or you know, what are the necessary arguments for active management in this environment?
Well, I think dampening of volatility is not helpful. I mean, in some, not just in fixed income markets, but in equity markets where correlations have gone up, it's been challenging for active investors. I think when you turn to the less efficient parts of the market, it should be very attractive to be an active manager. But the high transaction costs and herding have meant it's still pretty challenging. If you look at the emerging market debt universe, it's not been easy for managers to outperform the index. And you think, well, it's like shooting fish in a barrel. How can it not be easy? But the fact of the matter is that for various reasons, the index has been reasonably well diversified and maybe allowed risk premia into the portfolio. So I think the interesting thing that's developing in fixed income, very unlike equities, is that more active fixed income managers are using ETFs, both for liquidity and tactical reasons, because they're very granular. And I think, you know, you can always find a nice bond to invest in, but it's been a very quick trade for a number of people. So I think we're seeing a little bit of a hybrid of strategies where people are using, for example, ETFs and our ETFs and other people's to implement active strategies.
Yeah, I think I'd agree with that. I think what we're seeing is a kind of bifurcation of the market. So for a lot of our institutional clients, they've gone down the road of what I would call kind of semi-passive, so buy and maintain type of strategies in credit, where, you know, they purposefully restrict turnover to stop the kind of leakage of performance. But that relies on pretty heavy and intense credit selection, so there's an active part to it. And then on the other hand, more total return, non-benchmarked, diversified, unconstrained policies, strategies which need that liquidity. They need to be able to get in and out of markets quickly. And I agree with Rick that, you know, ETFs is a good vehicle for doing that. The kind of traditional benchmark, you know, trying to beat the benchmark by 50, 100 basis points a year, that kind of strategy seems, certainly with our clients, less in favor these days.
Yeah. Regina, is that something you're seeing as well?
Well, I think for us at Robeco, I mean, we have had very strong inflows in our active fixed income funds, particularly in high yield and in our global credit, and even actually our rate strategies, because our alpha performance has been very, very good, and you know, our value orientation with consistent risk management and profile. So we do have a differentiated offering for many of our fixed income clients. So I think business-wise, we've seen slightly different, but you know, we are considered you know, in a smaller size compared to some other managers in an overall fixed income sense.
Okay, great. I think we're coming to the end of our conversation. Unfortunately, I'm sure we could go on for an awful lot longer. I guess maybe we could have a quick rundown and just summarize where we've been at. I don't know if Virginia, you'd like to start us off.
Yeah, I think that, you know, at this point, you know, we view that you know, a lot of good news is priced in. A lot of the valuation that we've seen during the sell-off is not there anymore. So we're pretty much positioning being close to home, but being opportunistic if volatility comes up the next several months. And yeah, I think that, you know, we're ready to do more relative value trades going forward.
Great, thank you. Richard?
We are neutral on duration. We do like credit, and where we've got kind of total portfolio design, we like emerging market debt, as I mentioned, with things like gold as a little bit of a hedge in there at the total portfolio level. And I think this bifurcation between the safe gilded cage of central bank assets and the free world is one where we sort of favor the free world, but we've got a lot of clients who need to stay close to home. So I guess it really is a liability and liquidity driven decision for many.
Yeah. And Chris?
Yeah, I'd agree with that. Broadly kind of positive on credit. I'm not fully buying into the yield curve steepening trade. I think it's a bit too soon. I think there's, you know, technically there's still a very strong bid for duration globally. When I look at the equity earnings numbers, they're not picking up in terms of the cyclical forecast. I don't think we're in that very strong cyclical reflationary trade yet. So I'd be a buyer of long dated treasuries if we see a little bit more of a rise in yields.
Okay, great. Well, thank you ever so much for the time. It's been a pleasure, and hope to see you all soon.
Thank you.
Thank you, Dan.
Thanks.